So yeah, so you've probably seen some of my stuff that I wanted to talk about today. One of my favorite subjects is thinking about macro and using macro productively. And we were just talking about this, and there are a couple ways to use macro. You can look at really high frequency series, whether it is weekly series, monthly series, quarterly series, and then you can look at macro from the perspective of how are things going to develop over a secular time horizon. And if you're a value investor that likes to discount 10, 15 years of cash flows, I believe that paying attention to macro is incredibly important. It determines a lot of the things that have to go into how you value a company. So first I wanted to do a poll. How many people here run derivatives portfolios? Okay, two people. And most of the rest are equity people, I assume, correct? Okay, we'll get back to that a little later in the presentation, why I asked that. You know what? Do I have the wrong clicker here? I'm not advancing here. I'll just use that. Okay, so we've been told by Warren Buffett, don't pay attention to macro. And I don't want to be an iconoclast, and Buffett's the best, and so I don't want to argue with the master, but I've been long tried to figure out, well, why would that be? And also, one of the first books we've probably all read is Peter Lynch's Beating the Street, where he says if you spend a minute of time on macro per year, that's a minute wasted. And so, that's the orthodoxy that I think a lot of us grew up with. And there's a lot to be said for that. Sure, that makes sense. If you're trying to trade on high frequency macro factors, it really is kind of a losing game. But I was looking at on this chart here, so we're looking at 1947 to 1983 or so. And this is, Peter Lynch got out of investing right around here, and Warren Buffett, this is his whole investing lifetime. And this is GDP. And you have, business cycles, and you have yearly cycles, and, whatever secular cycles here. And this is leverage here. And this is government and household debt to adjusted personal income, which I'll get to a little bit later. But if this entire period, you didn't have any increase in leverage, systemic leverage in the US economy, and you had a lot of nice business cycles, things went up, things went down, macro really didn't matter. So if you grew up and you succeeded in this time period, would you not conclude that macro really doesn't matter? It doesn't, at least on this series here. And then early 80s, we had a regime change in terms of how we think about fiscal policy and debt. And we moved up in terms of gross leverage about 75 percentage points. And this is 175%. So government and household debt to adjusted personal income of 175. And this whole post-war period was around 125%. So we moved up about 50 to 75 percentage points. And we had this big growth surge at the beginning of the 80s, and the 80s were very good. And then the 90s, of course, we had a secular innovation and a lot of growth and demographic things going on. And that increase in leverage didn't hurt us, and it actually came down. Until we get to Alan Greenspan in the early 2000s. We had the dot-com bust, and Alan Greenspan decided we need a little medicine. So we got the medicine, and we really juiced up the overall leverage in the economy, and we went from 175% to 250%. So what happens as we've done this is the secular growth rate of the economy has gone down. Now, there are a lot of theories as to why that might be, but I think that people act differently when they have a lot of leverage on. I think the decision to take on incremental leverage or the decision to spend an incremental amount of dollars is different when you have low leverage than when you have high leverage. Here we break down the two components of the leverage. This is consumer household debt to adjusted personal income, and that has been secular from basically the 1930s forward, and basically post-war world forward. And that's, this peak here is the housing cycle. And the consumer leverage has come off, some. So what have we done to solve for the missing incremental demand coming from consumers? We've increased the government debt to maintain growth rate of aggregate demand. So those two lines are just disaggregating that one big green line here. So why do I say adjusted personal income? There are accounts that are available at, I always Google BEA space NIPA, so it's National Income and Product Accounts. And there you can disaggregate, consumer spending into a lot of different categories and disaggregate personal income into a lot of different categories. And within the personal income accounts, you have wages and salaries, proprietor's income, and then this line that's called personal current transfer receipts. And essentially that's Social Security and Medicare. Those are the big ones. There's unemployment insurance and some other things in there, but it's Social Security and Medicare, as well as Medicaid. So at the outset of this chart, 1945, personal current transfer receipts was 3% of personal income in this country. And today it's 20%. Almost sevenfold increase in that component of income. Now, a dollar of income that you generate is going to be a lot different than a dollar of income that my mother or my grandmother would receive from the government and spend. Is she going to run out and buy a Harley Davidson on a whim or a boat on a whim? No, because she's going to spend it on pharmaceuticals, rent, and maybe some help, medical help of some sort. And she's also not going to receive all of that in cash. A lot of this income is in kind. If you're receiving Medicare, you can't just go and blow that on a new side-by-side from Polaris, right? I mean, it goes to the doctor. So the discretionary component of personal income in the economy is greatly reduced today than certainly 60 years ago, post-war, and certainly even 40 years ago in the heyday of guys like Peter Lynch, who is famed for consumer investing. So I broke down here the different sources of disposable personal income, and this is the top numbers here are pre-tax as a percentage of disposable. So it sums to more than 100. And then we have personal current transfer receipts. So that's all of our personal income gross of taxes. And then this is the tax that's taken out of all of these numbers summed. So in 1935, in the middle of the Depression, the tax take on the economy was 2%. And then in the 50s, it was 14%. Notice this is pretty well aligned with personal current transfer receipts. 3% of income went to 5% in the 50s. 10 years ago, 9 years ago, it was 16%. Today it's 20%. Every month or every day, 10,000 baby boomers go on Social Security and Medicare rolls. So that's about 300,000 gross adds per month to Social Security and Medicare. What's non-farm payroll per month? Like what's a number that gets the market really excited or really bummed out? Remember the May one this year? Yeah, we're around like 230, 250. So these are people that aren't working. They've done their work, and now they're receiving a transfer out of our current income through the tax line to them. So we need at least, so in the last year, the net adds to Social Security have been $150,000 per month, but that's going to increase as more baby boomers retire. So you need, I think, at least 200,000 people per month to be added to payrolls to even offset that, and that might be conservative. In any case, the point here is over time, and is this thing a laser pointer? This is a laser pointer, right? That's not. Over time, the labor share of the economy has, there's really nothing wrong with it. And the capital share of the economy, depending on who you listen to, the evil corporations, how much of the economy are they taking out? It's not really different over time. Here's the big change in the economy. And this is also not funded, by the way. I know a lot of people think that it's just a perpetual thing that can go on and on and on. But when I think about a consumer company that I'm investing in today, I realize that this source of income in the economy is going to grow, and something has got to fund it. And it's going to come out of our active paychecks. The dependency ratio in the economy is growing over time. This is a fun one that I love to talk about. And I used to run the consumer group at Legg Mason, and my boss would talk about the profligacy of consumers and how we're all consumption-based, and I guess it was some sort of moral failing. And when I started to read these accounts that are on the BEA website, I ran into this idea of, well, is the consumer really 70% of the economy, given that we know that the transfer receipt, the personal current transfer receipt income for the economy has gone up this much? So what I do here is I take personal consumption expenditures, and then I take out that essentially that non-discretionary income line, PCTR, for which the total propensity to spend, I think, is 100%. So we take it out of this series, and what we see is a huge secular decline. I mean, this is, a chartist could have some fun with this and draw a line from that one peak over on the left in 1947 to today. And, this was the housing bubble here, and we've backed off, but still, the consumer, the real consumer, people in this room that are not retired, that's falling as a percentage of the overall economy. And we're getting to, toward a, below 50%. So the consumer is not the economy. Consumption is the biggest part of the economy, but how it's funded and how people act, I think, are completely different. So just to illustrate that a little bit further, I broke out personal consumption expenditures as a percentage of GDP is the top line, and then I take out that personal current transfer receipts as a percentage of GDP. And then we look at government and government plus PCTR, just rearranging the Keynesian national income accounting equation. Who here has done Economics 101 in college? The first thing we learn is C plus I plus G plus X minus M, exports minus imports, equals GDP. And do you remember they mentioned transfer payments in that when they were discussing that equation? And you're like, I don't get it. What do you mean? They transfer it into another part of the equation. Okay, so here's what it means. On the government's P&L, an outflow to a Social Security recipient or a Medicare recipient, that would be an expenditure. But in the national income accounting equation, that's not counted in G, government spending. That's moved over into personal consumption expenditures. So it looks like on the traditional Keynesian income accounting equation that the government has been, in the 70s, a much bigger part of the economy. And we're on this nice little glide path down. We're getting economies of scale, and we can handle all the debt that we're accruing. But what I do here is I move the personal current transfer receipts back into G and out of PCE. Very, very simple movement of the factors in the equation here. In the midst of the Depression, the government was 18% of the US economy. Today it's 33%. We're nearly twice as big, and that's going to go higher. So to me, that colors how I look at discounting or forecasting the future for almost any company. And certainly it affects the way I think about policy and a lot of other things. So today, given all of these things, if the tax take is going up and leverage is going up in the economy, how do we keep on growing? This is the consumer savings rate. Bottomed in at the housing market when liquidity sources were raging, and we felt good about spending. Although we should have, during a secular growth period, we should have felt a lot better which you actually see in the 90s. People are feeling better and better and better, and I guess sometimes you just overshoot. And this is, I think, what Greenspan was trying to do. But then, oh my gosh, we get into the global financial crisis. The thing, remember potluck parties were like a thing in 2009, and people were becoming, much more responsible. And well, that passed, and here we are on the way back to 4%. So we're saving 4% of our incomes. I think that's a danger point from a macro standpoint, and it colors the way I think about growth for certainly consumer-facing companies out there. So as we talked about before, I think this PCTR issue is a problem that needs to be funded. When you look at the demographics of 10,000 baby boomers retiring per day, that's 300,000 per month, and that becoming a bigger part of the retirement population, that plays into how you look at unemployment rate or non-farm payroll growth, as well as wage growth. It plays into the tax share on gross income. If the tax take on the entire working population increases over time, of course, unless they save less, they're not going to be able to increase their spending at quite the same rate that we'd all like to see, but I think it becomes harder from here. The other point is, if you take on its face the Keynesian national income accounting equation, government's really not as big a deal as in the past, and there's room for expansion. I know a lot of people today are saying, well, we've done all we can with monetary policy. Let's try infrastructure. Our infrastructure is dying. Let's pour money into infrastructure. Well, the government is as big as it ever was, and almost twice as big as it was during the Depression, when we were building a lot of infrastructure. And is that something that's going to move the needle, or is really something that we can take on? I don't think it's as easy a question as a lot of people have advocated in their frustration with monetary policy that is long in the tooth at this point. So I think for long-term investors, all of this should play into our growth rate estimates, our competitive diagnoses. Look at Amazon. Amazon I think will always exist on a pretty thin margin and a very high capital turnover rate. And anything with a big profit pool that they are supporting with lazy capital, like I think Comcast, I think that's going to be any big fat profit pool out there that Jeff Bezos can attack, he will attack. And you look at Costco, they exist on 3.2% EBIT margin and really high capital velocity. Which is a better competitive weapon to take on challengers? High profit margin, low capital velocity, or low profit margin, high capital velocity? These are going to be the mechanisms that deliver value in I think, a low growth, non-inflationary world versus something like a Bed Bath & Beyond, or Ulta is one that I look at their profit margins and I wonder how sustainable is that over time. This also plays into how we think about discount rates and credit spreads, and as I said before, the policy advocacy positions. So I asked who is in derivatives and who is in equities. I think we're all in derivatives. When you look at an industry is a derivative of the macro economy, and a firm is a derivative of an industry, and equity is a derivative of the capital structure and any residual liabilities for a firm. We're all doing 3 times levered derivatives as equities people, and we learned that early, that we're the last in the line of claims for residual net asset value and income streams. We got to pay debt, but I think all of these things, macro matters, because we really are at the bottom of not just the firm waterfall, not just the industry waterfall, but the macroeconomic waterfall that determines everything below it. Any questions before I go on to the investment idea?
I have a question
Mm-hmm.
So your point there is basically, let me just restate, you correct me if I'm wrong, that if you sort of back out, if you back out government handouts, consumption has actually declined over the last 70 years.
Consumption is a percentage of the economy.
Right.
Yeah.
But is that the right way to look at it? If let's say I'm a retiree who spends 10% of my money on food and 10% of my money on healthcare, wouldn't that 20% have been, it would have been included 70 years ago, and
Yep.
now it's just instead of me paying for it out of my own pocket if I go to McDonald's or whatever, now the government is paying for it.
Yep.
But is that really? Can you really say that like before I was spending $100 and now I'm
Yeah.
spending 80 on the rest, or is it just?
Yeah, for me, I mean, look, these are dollars that get spent. And HCA, Hospital Corporation of America, is one of my biggest positions because it does benefit from this, in addition to being just a really well managed company. It does benefit from the growth of this spending. But first of all, they're probably spending more than 25% of their income on healthcare. But I think what I take away from it is the discretionary aperture, the discretionary the discretionary dollars that they have under their control is much smaller than for a 35-year-old couple. And it's the likelihood that it gets spent at CVS, Walgreens, at the hospital, at the Blue Plate Special at the local diner, like just the menu of options for this consumer unit is greatly reduced. And when you look at something like a Polaris or a Harley-Davidson, Harley-Davidson once great company, Polaris, most recently great company, can't get out of its own way now. I think those are important factors in those things, especially on discretionary things. But even for packaged food, I mean, I'll talk about a packaged food company in a second. I mean, how much are Twinkies going to grow over the next 15 years? Yeah. Well, that is a nice incremental growth driver. So we'll talk about Hostess. I'm sorry.
Did you use gross or net transfer payments?
Gross. Yeah, and then I took the.
So back out payroll.
Yeah, then I took income tax and I took personal taxes of all sorts. So including withholding out of that tax line that I provided. Yeah, but you can see how big the tax take, including withholding tax, versus the outflow to PCTR is almost equal. I mean, it's by far, I think, any policy position that does not address entitlements, which we know is a political, suicide on the stump, we can forget all other fiscal policy discussion. The idea of fraud and waste is going to solve our problems. Just the numbers don't add up at all. It's just, even fiscal responsibility candidates, cannot, address this. Let's take out PBS funding. Great, that's 0.03% of the federal budget. Doesn't do anything. So who here knows the story on Hostess? I know okay. So Hostess is a company that I actually owned in bankruptcy like 12 years ago or so, and made a little bit of money because it had this outmoded labor model, which was a Teamsters labor model, which came about after the Depression and certainly in the 50s, where we're this really rich country, and we can afford to pay people driving around Twinkies a really great wage, and it was right for the time. But it became wrong for the company and a whole set of industries in the next 40 years. And then they had this thing called a multi-employer pension plan, which is a joint and several liability far worse than the worst nightmares that could ever be attached to asbestos. It is, for instance, YRC, a trucking company, an LTL trucking company, with a $100 million market cap, has a $10 billion off-balance sheet liability for its multi-employer pension plans. That's what this poor company had as well. So they went bankrupt in 2005. It took them like 6 years of reorg, and then they came out around 2008 or 9, and they went right back into bankruptcy 3 years after that because they didn't get rid of these liabilities and the labor model. So It reemerged in 2013 under a fellow named Dean Metropoulos, who revived the Pabst Blue Ribbon brand, which was deader than dead, like 10 years ago. And he had a son who was maybe 25 at the time, and they made it the hipster beer, and it was just an awesome turnaround for this thing. He's done Pinnacle Foods, he's done Advanced Pierre Foods, and Pinnacle's a bit of a roll-up, but they bought cast-off brands like Vlasic and I don't know, all sorts of salad dressings and whatnot that bigger companies were puking because they just couldn't deal with, just get it off our hands. So they put it into this roll-up device, Pinnacle Foods. So this is not a roll-up device. Maybe it becomes one, but it has a 16% market share of the $7 billion sweet baked goods industry. Now, it recently, because it emerged from bankruptcy, had all of its assets marked up, which actually gives rise to luscious deductible amortization of purchased accounting intangibles. But Xing the marked up assets out, this is doing an 18% return on tangible capital. It's a really good business. I mean, Twinkies, it's hydrogenated oil, a little bit of flour, a little bit of natural gas, and some sugar. And the beautiful thing is it used to be a direct store delivery model, and now it's 100% distributed by third-party distributors. So fully variable model on distributing versus the old Teamsters direct store delivery model. And that's why they can operate at a 33% margin. Right now it has a market cap of $1.5 billion. It's coming out with $1 billion in debt. So the debt right now is 4 times EBITDA, which would probably cause more people to blanch 10 years ago. It doesn't seem so sporty today, but I'm a little old-fashioned, and that gives me a little bit of pause in terms of a multiple for a slow-growing but stable thing. But the beauty here is they're spending, given this fully distributed model, they're only spending about 2% to 3% of revenue on CapEx and D&A. And so this company, having been fully scrubbed of lots of nasty stuff, is translating 100% of their net income to free cash flow. So what we have here is in year one, they're coming out with 4 times debt to EBITDA. They can pay down in year one 11% of the debt, and by year 4, about 20% of their debt. And having talked to the CFO, I was very nicely surprised that he said if they can't find acquisitions, which everybody likes to do, sure, they will pay down the debt. So this is almost like a true private equity thing where you're starting out at X with leverage, you're paying it down, and then you're looking at, all right, what's the thing going to trade at the end of it? So this year, and when I told Fred that I was going to do the presentation here, we were trading a little bit more cheaply. Today we're trading at 14 times 2017, but that implies almost 7% free cash flow yield, which for this asset, and I don't think there's a whole lot of growth, and I certainly don't think there's any margin expansion potential off of a 32% EBITDA margin. It's an okay price. I believe currently there's 11% upside, which, it sounds pretty pedestrian, but because it has that 4 times leverage, I used a higher discount rate. I think in year 1 through 5, I'm around 13%, which is, maybe a little conservative, but I think if it unwinds the, its cost of equity and you have this straight line accretion to fair value as it stands 3 years out, this can do a 15% 3-year IRR. So the 11% upside doesn't sound so good, but it unwinds to a pretty good IRR. Yes, sir.
When did the IPO come out?
Well, so it's coming out via a SPAC, and SPAC is one of the reasons why this wasn't fully appreciated.
So is it out now?
The SPAC is trading, yes, under Gore's Holdings, and there's.
Because Interstate Bakery sold some of their stuff to Flowers Industries also.
Yes, sir. Yeah, those are the packaged breads.
Right. So I am heavily invested in Flowers.
Okay.
And the stock's done bad for me. As of now, because there's some lawsuits there. What would you rather invest, you think, in Flowers, an established company that has many products versus this one?
Well, the distribution model destroyed this company, not once, but twice. And I think Flowers has said, man, that distribution is really tough. let's go to an independent contractor basis. And that's the big trouble there. Now FedEx got through its independent contractor, class action lawsuits, and everything's fine. And I think Flowers can probably do that too. But I don't really want to, mess with that. So the reasons why I like this is bread is really competitive. Packaged bread, you're competing with Bimbo and all sorts of other regional. It's very regional. The brand equity in Twinkies. I mean, I had one recently. It was a little too sweet. I like the Ho-Hos. Those are good. We have the deep fried Twinkies coming out. Tasty Cake, which is big in Philadelphia area. Yeah. Yep. Now, Tasty Cake, they do have brand equity. I think the brand equity here is really good. So there's more hair on that story. I can see where that is a value story. But this is coming out with a very clean balance, very clean operating approach, and a much cleaned up balance sheet. There are some warrants that are trading, and the Black-Scholes today last night was $1.93. If you believe my $13 valuation on the company, the Black-Scholes value would be at $2.39, and the warrant closed last night at $1.34. So there's more leverage in that instrument. We have Apollo and Metropolis are selling, some of their shares are going to stick around with a big stake post SPAC IPO, and Goris Holdings, which is another private equity group on the other side, they have a definitive merger agreement. We've got a date for the vote. I don't think there's any deal risk on that. This is where we have the most delta to, if I'm right on the valuation of the thing.
Why did you do the SPAC structure? Why not just do it on IPO?
It's a smaller market cap. It's three private equity firms that are dealing with one another. Also, Metropolis is able to claw back about $160 million in tax benefits that wouldn't fly in an IPO. And it also gives them, I think, a vehicle to do acquisitions in the future. And at the current $725 million revenue rate and $225 million EBITDA, they can find acquisitions small enough that can move the needle, that really don't disrupt any bigger industries, or really too small for bigger competitors like Rich Products to do. Yes, sir. I don't think so. Yeah, I haven't seen that in the filings. So I didn't have a ton of Bill Ackman slides on this thing. It's a pretty simple, it's a slow growth, very cash generative. I like the ownership group, and they're going to stick around. Almost 7% free cash flow yield, unwinding a 14+% IRR over 3 years. I like it, and it's not that complex a story in my mind.
It's almost like a piece of cake. I mean,
It is. You're the quip master.
actually have one. So I don't know. When I played soccer as a kid, they used to always hand them out after the game. Like, you get like orange juice and like a Twinkie. We build big, strong athletes. But I had one recently. And are they the same as they were before? Because they didn't.
Oh, they've
taste like they were.
they've come up with extended shelf life technology to improve upon the former extended shelf life technology.
For the zombie apocalypse.
Yeah, it is not in tune with. It's not in tune with what you think about, like what's happening in dietary trends. But I believe that no one has ever made a lot of money going long the dietary or financial mores of America, which sounds really bad. I'm sorry, but.
It's one thing to say it, it's another thing to actually do it.
All right, thank you very much.